The stocks finished up the week on a high note, right at the highs of the week, high of the day, high of the week. We ended up with an overbought cluster today on the S&P 500, which is actually not a bad sign. It's actually a really, really good sign. But there's obviously that's not the only signal. If that were in and of itself a signal by itself, that would be really bullish. We're going to take a look at everything else to see how much more support it has from other signs to see how bullish we are. Whether we find, this week was a really important week to really break through, follow up on last week and break through resistance. Did we do that? Are we still at the resistance? And what can we expect next week? What's the story that volatility is telling us right now? What's the story that bonds are telling us this week? Because there's a big divergence right now between bonds and stocks from what had been going on into this last couple of weeks. We're going to take a look at that and see what our expectations are now going into the next couple of weeks, heading into April expiration. So let's go ahead and get started. Today is Friday, March the 25th, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast indicator on the S&P 500, and look at that cluster, an overbought cluster. The intermediate line making just a smidgen into above 80, 80.78. The momentum line getting slightly above 80 as well, with a nice little push at the end of the day, and closing right near the highs of the day, right? Obviously the highs of the week, just a few points off. Very, very good, right into that 45.50 area, which is where obviously that 62% retracement level is, and 4.25% above the 30-day moving average, well above the 2.5%, and hitting that 95th percentile for this past year. I mean, the last time we were getting green dots, we were kind of in this area, and then over here, we had a good strong run. So really, really good move, way to finish the week for the S&P 500 to get this indicator. A lot of times, that at the beginning of trends, that can be really bullish because of the momentum line. Again, we've had kind of smaller ranges, and today wasn't really the biggest range, but the fact that we closed at the high of the session really kind of put that momentum line up to levels, because it was actually down earlier today. It pushed it up to levels to overbought levels, which produces the cluster there. Really good signal. So you can look at the Nasdaq 100. Did not quite get the cluster, though. If the cluster was at the 75th percentile, you'd be really close. They're all up at relatively bullish levels. The Nasdaq is not at its 62% retracement; it's at its 50% retracement level. The intermediate line not quite getting, but 5% above the moving average for the Nasdaq. And then finally, your Russell 2000. Not nearly as bullish, right? Not anywhere near a 62% retracement. It's at the 38. It's not even above the 38% retracement, and the near-term line is not anywhere near the upper reversal zone, and neither is obviously the momentum line. So, and you can see the intermediate line is above 80, but not really really solidifying its position there. So, pretty much the best bullish signal we got was on the S&P 500. If you go back to the S&P and look at the weekly chart, look at that strong, both the momentum and the near-term line finishing the week. The intermediate line still in bearish territory, but rising, but a really, really good, strong push up to the upside. I mean, we haven't seen that previously. That a lot of people have been comparing this move to November because of all the 1% or moves to the upside we've been getting of 2020. Obviously not nearly the same. We didn't get both these lines pretty much to extreme levels. 98th percentile on the momentum line, 99th percentile on the near-term line. Really, really good move. Sitting again right at the 62% retracement, a little bit above the 30-week moving average. Looking at the Nasdaq 100, you see something very similar, very strong intermediate or short-term lines, with the intermediate line still rising in bearish territory, obviously not above its 30-week moving average. And then the Russell 2000 is a little bit further below the 30-week, and the short-term sentiment was strong, but not as strong, and the intermediate line is actually a lot lower, the 4.5%. So not quite as bullish on the Russell, though. When you look at this chart, I mean, that's a good bullish candle, and as of right now, we'd have a bullish candle next week on the S&P, on the Nasdaq, and on the Russell. Really good bullish reversals. Obviously not as strong a move to the upside on the near-term line, and not up above the 40-week yet, but still bullish signs here on this particular chart. When you look at the 3 green arrow charts, remember the histogram on Wednesday had rolled over. It's actually still rolling over. I mean, as while we're rallying here, we're still kind of falling on the histogram. So remember the actual MACD itself will peak after the histogram is peaked. So if the histogram is peaking right now here, then that means the MACD is soon to peak. Now, it might be within a couple of days. It might be still quite a while before it peaks to the upside. And you can see some other examples of when the histogram peaks and then the MACD itself peaks. And you notice just because the MACD peaks and we start to drop below its moving average, that doesn't mean the stock itself will drop below. You know, it can be on a convergence mode here before getting a little dip. That would be a good buying opportunity. Well above the 200-day moving average. The 8 and the 17-day are both crossed easily above the 30. That's a bullish sign. As you can see, that typically leads to a good bullish run. And they're about to actually cross the 50-day there. So a good sign from that perspective. When you look at the weekly version, you'll notice that, again, I told you we were at the 30-week moving average. You know, that we're just a smidgen above, easily above the 17-week. The MACD is not crossed above its moving average yet, stochastics has, but again, you can see where the resistance is right now, and really where we need to get through on the upside. If you take a look at the Qs are sitting right at that 17-week, in this case the 50-week as well. So it's not quite there yet to being like in a bullish trend, and the Russell actually is holding the 17-week so far, right? Its histogram MACD has already crossed through zero. The histogram's turned positive already, and you can see the volume really tapering off to the downside there. When you look at their daily charts, again, the 8 and 17 have crossed above the 30, and the price is above the 50, but again, not above the 38% retracement. And the Qs did get above the 38% retracement. It's trying to fill in the gap between the 50 and the 200 as well. The 8 and the 17 have both crossed above the 30-day moving average and the point of control for that matter as well. That's going to be important when we come back to the 17-day, because you'll make a run back to the 8, you'll make a run back to the 17, and again, the MACD will peak and cross below its moving average, but as long as we stay above the 17-day, then we can just grind higher until we get a new opportunity to bounce up, right? Something like this, where we just maybe take a day below the 17 and we bounce right back up and keep going again, and we stay grinding higher the whole time the MACD is below its moving average, right? That's a potential. I mean, usually wouldn't be the case here, because over here you're well above moving averages, and here you're actually still below. So a little different scenario in that regard. That's why you wonder, it would be rare to be below the 200-day moving average and get an extended bullish convergence like this. Which is typically what you get when you're really bullish and are kind of in a very mature bullish run. Obviously, that's not the case right now. If you take a look at some of the other oscillators, they're showing some decent signs too, just a smidgen above 60. We need to really get above 60 to change the trend, right? You get above 60, and then the lows get a little bit below 50 and kind of hold the 40. That's the bullish range right there, and we've been in the bearish range ever since. So we need to break out of this bearish range and get up ideally above 70 and really kind of solidify us in this bullish range. Same thing here. We're not really getting it above 150, which would be the ideal scenario, or 200 to get into this good bullish range instead of being in more of a bearish range right now, at least at the ceiling of the bearish range right now. Good patterns here. The positive indicator has jumped above 25, not by much, but at least it's jumped above 25. The negative hasn't dropped below 20 yet. So we'll see, if this ends up being, the turnaround as we've seen before. Like I said, IWM had previously gotten a very similar signal, and you can see we're not, it's both lines are between 20 and 25 right now. If you look at the Qs, they're both between 20 and 25 as well. So not really too bullish on the bullish on that either. Remember, we talked about how oversold that was and what a great opportunity that was. With the oversold cluster and that arrow on the DMI to at least get a short-term bounce. And boy, did that short-term bounce turn into a really good bounce over the last couple of weeks. Looking at the Ichimoku cloud, we are not quite up above that 2 level there, and not quite above, but we are above 65. So we're almost to where we're getting a good intermediate trend going, and being above the cloud would be very good breakout for the S&P. The Qs, not quite. We're still kind of holding the cloud for resistance, and again, like I said, have a weak bullish trend, but not a good strong intermediate trend yet. And then IWM, you can see that it's no trend, right? It's still very, very noisy, and it's still no trend here, and we're still in the cloud and holding the top of the cloud for resistance, and really kind of dropping in the ranges and dropping in the volumes as we head into these resistance levels, right? The volumes well below the average, 76 million. The range today at 4.5 points. So when you put those numbers in context, 76 million is way down here, well below the average. 4.5 points is well down here. So I mean, those are really, really low numbers, which brings these lines down. That's bullish. But again, we're still below moving averages, and that's that's the issue in terms of you'd like to get above those moving averages and get some good bullish trends going, established, before you start really tapering off too dramatically with these ranges and volume levels. When you look at the VIX really dropped today. It's by the end of the day, didn't quite get below 20, but it did dip its toe down there to the 85% level. Last time we did that was a few weeks ago, well, actually a couple of months ago, the early part of February, and then of course that led to a really strong rally up to the upside. And so that's the big drop right there, down to 85% and down to 20, to see if we're able to actually get through that or not, and rally back up there to the upside. If you look at where we are, where the VIX is on the daily chart here, really important level, right? Getting below 20, getting below the 200-day moving average would be really bearish for volatility. Obviously, it would be really bullish for equities. You can see the MACD, the histogram has already bottomed, so you expect that the MACD will bottom, and you can see when the MACD bottoms, we don't tend to just grind right to the downside here. We tend to bounce up here lately, especially. And so we'll see if that ends up being the case. If we end up getting a bottom, especially with stochastics, especially with the average for stochastics being pretty much as low as we were back here in early January, and as low as we were back here in October, and that led to some pretty decent runs and volatility over the next few weeks after the stochastics got the average for the stochastics got that low. So what do you think? So the idea, the expectation is, again, next week, we're here, we push through. It was a nice, good follow-up this week. It was very small range, very small volume. It wasn't really a push through after such a strong week last week. So that means, okay, we kind of got up to these resistance levels. We tapered into those resistance levels. Now we're either resistance is going to hold, or we're going to really punch through. And when we punch through, we have an opportunity, for a good intermediate trend coming. Again, we haven't had a correction yet. We haven't had a bear market on the S&P. We haven't even had a correction on the S&P. We have had one semi correction on the Russell 2000 and the Nasdaq, because they did get their midway between the 50 and 200-day moving averages, probably about a third of the way on the Nasdaq. The S&P never did really get below the 50, and only a couple of weeks and we're right back above it. So we haven't really had this deep pullback on the S&P, but even a deep pullback can lead to a good intermediate rally. We're already up 8%, 9%. What was it? We're already up. If I were to do the zigzag chart here, and we're already up 9% off of that low point, 13. Now the problem is, if you only get a 10% drop after a big number, you don't get a big green number coming after that. You get a big green number and you get only a 12% drop, then you don't really get a big green number coming off of that before you pull back. And so we had the bigger number than pretty much both those two combined coming here, and we had a 13% drop, similar again to what we saw there and there. And so now the question is, am I going to get a 40 or a 50 or a 60 in this box? where it's right now it's 8.93, or am I going to stop at 12, 12 or 13? Right? If we get up to that 78% retracement, you're at 12. And so, that's kind of typical of what we've seen in the past. And if that's the case, that might be all we get. And before we finally get, as we saw over here, more of an extended period, 15, 16, that was a correction. It did hit the 200-week moving average. This was a correction. Eventually we did get a correction, and we did get down to the 200-week moving average. Are we in line for that kind of thing again here after getting, a 9-10% rally to the upside on the S&P? So that's kind of my expectation. Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am, or why you might be a lot more bearish than I am? Post those charts or indicators there in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked the video today. And it also tells us you want us to do another video again tomorrow. So if that's the case, click that thumbs up icon. If that's not the case, you don't have to click on anything. Also, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have about what I brought up? Post those in the comment section down below. Join our website on marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon here. It takes you to our Market Outlook live page. At 3:30 Eastern Time on Monday, Wednesday, and Fridays, including today, I do a live video here, 10-15 minute video. I took a look at all the trades we've done in prior market outlooks to see whether we should stay in them or get out of those trades. We also put on today's trade idea already before the market closed in this live video. You can see all the archives there too. You can also get to it by clicking on live trade review in our main menu here. Come down here, you can see our upcoming classes. Click on view more. That takes you to our calendar of all of our classes coming up, as well as 4 years worth of recordings going backwards. Come down here, click on that heart. We dropped. We hit 100 on Monday's video. We dropped back down to 77 on Wednesday. Let's see if we can get this back up to triple digits. That'd be awesome for us. Really helps out a lot. You just click on that heart. And it takes you to that page, and hit that like button. Same thing here, click that thumbs up icon. It takes you here. We also really dropped pretty sharply on this too. Again, the more you like us on these, it really helps us out. Just kind of make it a routine while you're watching. That's why we put it right here, so you can just do it right here while you're watching. All right, now let's talk about what's really driving. And inflation is the story of the week. You can see commodities were up big this week, 6%. Treasury yields are up big this week. The Treasury long-term prices down 3.5%. High yield bonds were down 1.5%, and you can see a lot of other equity asset classes were at least slightly negative. With really only the Nasdaq 100 being the biggest mover to the upside. Gold also up again. Inflation, right? And what's interesting is your dollar ended up being strong, and there's been a correlation between the risk appetite, especially from a mega cap standpoint, along with the dollar lately, instead of the safety trade, which you would normally expect. When you look at the currencies here, let me pull up all the currency charts and look at them for the week that we had here. And we'll just go back to March. You can see the euro is down. The yen was way down, and that's, again, a very safe haven asset class, the yen. But the yen yields over there on their treasuries, on their equivalent treasuries, their government bonds, have been spiking up huge. For them, is big moves to the upside. And that's really pushed their currency down 2%. That's a huge move. Let me show you what that looks like on the chart. If I were to pull up a chart of, say, like the US dollar yen. Look at that move on the dollar this week. Big spike to the upside. Very parabolic move. In fact, when you look at it on a DMI standpoint, you can see the parabolic nature of that trade. Big jump to the upside. Way down. And again, it finished with clusters before when we've been this parabolic. and that ended up being the peak for the dollar. Remember, the dollar peaked right here too at the beginning of the year, and that ended up being the decline. And you can see too, it peaked here after Thanksgiving, and that ended up being the beginning of a decline too. So when this has dropped, there's been a decline in risk appetite. So very, very parabolic. And when you look at it, say compared to like the euro, which has also been weak, you can see the euro, the euro yen. That's what I want to look at. You can see it's been relatively parabolic too. Look at that strong move off those clusters for the euro. But again, it's been mainly weakness in the yen. In fact, if you were to come, back all the way here to March the 7th of 2022, and look at that same time frame, March the 7th instead of the 21st, so last 3 weeks. Let's go out to like a 15-minute chart. Again, there's your yen, there's your franc. Very risk on from a currency standpoint. Very risk on trade. If you look at it, and that wasn't always the case, but pretty much, the yen and the franc have been down for most of this period. So from a currency standpoint, we've pretty much been risk on since March the 7th. Let me show you what that looks like from an asset class comparison standpoint here, and we'll go back to March the 7th. Right there, so last 3 weeks, right? On equities, you can see the developed markets have been really bullish. Bonds have been really bearish. Commodities were bearish. They're about break even there, but there's U.S. equities and developed markets really bullish. Risk on, right, from that standpoint, especially coming off of the lows there on the 14th. A little bit of weakness originally, but then just really taking off. Emerging markets lagging behind. Gold down, high yield bonds down, because treasuries are way down. So big risk on move, and you see that here. And you can see the dollar is also down relative to a lot of these other currencies, especially these commodity related currencies: Canadian dollar, Australian dollar, Mexican peso, a lot of these Scandinavian currencies, gold, South African rand associated most with gold there. So a lot of commodity-based currencies really outpacing, and even the euro outpacing over the last little bit. Again, with your franc and your yen down. So very, very bearish move, and you see that across the board in a lot of different asset classes. Look at long-term bonds really finishing significantly lower this week. If you take a look at the weekly chart, look at that drop. Getting close down to that 78% retracement, getting close to this 125 level, maybe about 126.5, where there's a little bit of volume support. If you look at the directional movement index for long-term bonds, you can see you are well below 20, which for long-term bonds, as you can see this year, has been a significant level to the downside. Lots of clusters. We've been above 35 for quite a while on the negative indicator, to the point where the ADX now is above 25. Again, that doesn't really happen. Again, it's hard enough just to get it above 20 because this is kind of a slow moving. Look at the scale on the chart. It's not a very big mover. So to get it moving takes a significant move to the upside. We saw that there, and that ended up being a bottom. We're seeing it again. That's just to kind of show you some other examples. Look how. That was such a big move here at the end of 2020 for long-term bonds to drop as far and as fast as they did. When it dropped right there at the beginning of the year in 2021 to March of 2021. And if you recall, that like the Russell 2000 were parabolic, hugely parabolic during that period. And then the Russell peaked there in the middle of March, didn't go anywhere after that. That goes to show just how insanely bullish that move was, to go pretty much from just below 160 all the way down here to 135 to the downside there. Very, very tremendous, because you can see that again, it's not too common to get the ADX up significantly above 25, much less above 40, which is ultimately where I got to. This COVID drop. 2019 we had a couple periods of big run. The fourth quarter 2018 it had a big run to the upside, but not generally to the downside. Getting to the downside, you can see right here is another example. it doesn't go down as far as fast, and it goes up a lot faster. So keep that in mind when we're taking a look at just how bullish we are, just how bearish, we are on bonds, and what kind of move we might be setting up for if we end up getting a strong rally. It rallies slowly to the down, or moves slowly to the downside. It rallies very quickly to the upside, as you can see on the directional movement index. If you take a look, at the RSI and CCI charts as well, you're below 40, and you're diverging big time on the CCI. If you look at the weekly version of this chart, you can see the big time divergence on the CCI coming off of minus 200 there, and then now finishing the week below 30, which we finished again, that extreme move in 2021. Outside of that, getting below 30, just a smidgen, ended up being a low point that sparked a pretty decent rally to the upside. So very significant RSI finish on the weekly chart for long-term bonds. I also wanted to take a look at, we've been looking at equities. I wanted to take a look at Bitcoin. Bitcoin's, on this kind of far end of the risk spectrum. And you can see it's at level, it's been bullish, 8 and 17 day averages crossing above the 30. You can also see it's kind of sitting up against some previous highs that we've hit in this level. And it's also this 38% retracement. If I go back, so you can see where that comes from, it's this big post-COVID rally that I actually now have to go back 3 years to see. It's a big post-COVID rally that we broke below the 38% retracement and now have hit multiple times to the upside. A little bit of an ascending triangle, which actually you would expect to be a continuation pattern, not a reversal pattern. But if we break back above 45,000, then it would be a reversal pattern. But if it holds resistance, you expect resistance to hold until it doesn't, then again, you can see what happened the last few times that we've done this. Very important levels here for Bitcoin. So the other asset class that we look at is these ARK investments. Right, it's at the high end of that risk appetite scale too. You can see it got up to resistance and so far holding. Actually had more of a bearish day than anything else did today. So that could be a sign of what may be to come and along the rest of the risk spectrum. If you look at high yield bonds, again, that may be a sign of what's to come. You can see it broke below the lows. After rallying like everything else, instead of continuing to rally, it really rolled over. And again, you wonder if that may be something similar, right? We might be seeing something similar eventually in the equity asset classes as well. Let's take a look at how the sectors performed this week, right? Big risk on week, right? Especially from a equity standpoint. Lots of dark green shadings, a few green lines, right? Some of them green lines, yellow lines for everybody else, above the moving averages all across the board. So strong bullish moves in that perspective. If you take a look here at how they performed on the comparison chart. Let's go back here to this week. Right here. Our biggest winners this week were energy and materials. Again, I would have expected more of like a, technology and communication services and discretionary. Not really big winners, kind of laggards, especially those last two. Technology barely outpacing the market. So it's been an energy and materials gainer. And these are two very, very small sectors in the S&P 500. Not the best leadership if we're going to maintain an extended bullish run, right? It's not the best leadership to have. Healthcare down, real estate down, but your leadership that you want to see is technology, discretionary, communication services. They're the biggest sectors. Together make up about half the market, and these two together, especially with utilities too, make up a very, very small percentage. Like maybe not even 10% combined. Probably maybe up to 15% combined between the three sectors, 15 to 20%. So very small. Again, not your best leadership. When we're thinking, hey, we're really bullish here. Again, going back to November, if you go back to that, when we had the this November time frame, it's actually 2000. because a lot of people are comparing this run to November, because that's when we got the vaccine news, right? And we got all those big up days in a row, and we kind of started it. We came off that Halloween low point and really started a good move to the upside. Well, when you look at how, the biggest winners for that period of time, and we won't do the intraday charts. I don't think it will. No, it won't let us do the intraday charts because it's way past. But let's see if it will do. Yeah, you can do hourly charts. You can see technology, discretionary communication services were originally your biggest losers before they eventually took over from energy and financial. The energy and financial was so bearish during the COVID drop that they finally started to rebound significantly. As you can see, 17% in 1 week for the energy sector up to the upside. And there's your big horses down there at the bottom that finally started to gain traction, especially once we hit that March 15th. When you look at the March 15th peak here in equities, going forward from there, so going forward to say March of this year, well, let's just go to today. You can see that, again, energy kind of stopped going up at that point. Financials did as well. Communication services did, and they came down. Energy has been your big winner. Technology was your big winner. Communication services going into this early peak with real estate, incidentally. Communication services down here with technology and industrials and financials. Energy has since taken off from there while the rest of the market's been bearish. Energy has really taken off to the upside. It's been your one outlier, up 47%. Remember, it's been so down since really the mid-2014 levels, so bearish. And COVID made it so much worse. So big rally to the upside in those stocks. Everything else is kind of meandering right around, with communication services being an outlier to the downside. So we're going to want to see a change in leadership back to technology, discretionary communication services, right? That's the three-headed monster. That's where your mega cap names are. That's where the biggest companies and the biggest growth areas are. Those are the areas we want to see continue to lead us up and really push us into coming off of this low point, right? Because really this was more of you have to kind of look at this coming off of like the COVID low point, because that's the kind of market. I mean, this is the kind of big drawdown that we've been in. Not necessarily, again, a bear market or a correction, but that's the kind of drawdown that we were in there. So I'm not exactly sure what the exact date was of that low point. It looks like it was the 23rd. So if I were to go to the 24th, the 23rd, then you can see energy coming off of that. But look at technology and discretionary really leading the way higher. Communication services as well. There's materials and industrials and some of the other sectors. So your safety trades up quite a bit. 30-40% is a big move for utilities and staples, but obviously half of what the broader market got as a whole. Let's take one last look here at the big move, the big economies, and how their ETFs are doing. So let's go to the 12 grid. Okay, so Russia's still off the table, but and you can see like this is a really significant proxy for us that we want to really pay close attention to. It's great that the Canada's doing well, Brazil's doing well. UK is up above its moving average, Japan, but this is not a good sign. Like you want to see this kind of move as well on Korea being a proxy for global growth, economic growth expectations globally. Not doing so well. China obviously not doing so well either, and dropping back down 1.5% today. It's not your best moves from a broader global economics stock market standpoint. Does not see the same follow through that we're seeing in the U.S. and really in North America, South America, follow through into other global areas too. These other developed markets that are kind of just meandering around resistance levels. All right, for our trade, for our trade idea of the day, let's take a look at Dollar General here. It's had a great rally. Again, also getting clustered, very similar to the S&P. But this, after the cluster actually pulled back, which is not a bad thing. The short-term sentiment's down. Near-term line got into oversold territory, but not by very much. Momentum line didn't quite get to extreme lows, though it did get relatively oversold. I mean, it's not that big of a retracement. It's not even I wouldn't even gather it's a 20, probably, I highly doubt it's even a 23%. It's sitting right on the 23% retracement level. So really not that big of a retracement there. When you look at its weekly chart, you can see that it's a great change, right? We got back up above. We've been in this death cross environment. The PPO is rising. We got back up above these good bullish candles. Really, really good change in direction here. When you look at the MACD and the stochastic indicators, well, obviously they're coming down. The MACD peaked with the histogram in this case and is rolling back over. Stochastics rolling down. We got above the 200-day moving average after earnings, and now we're kind of holding back down there. You can see that we're back into the value area. We're back towards the 8-day moving average. We're back sitting on the point of control. If you look at the Bollinger bandwidth, we are right in the kind of back in the middle bandwidth, just underneath that 75th percentile. Very, very large bandwidth. So you expect that bandwidth is going to really start to shrink up a little bit. When you look at its directional movement index, you can see we had a pretty extreme move to get the positive indicator up to almost 40, the negative indicator almost down to below 10. Now it's kind of shrinking, right? You would expect that it's probably going to start really slowing down here. You're above the cloud. You have an opportunity actually for it to retrace a little bit more and still stay above the cloud. You have a strong trend. You're above 5, you're above 80. So you have a strong trend going on the trend strength indicators. The RSI and the CCI, you can see we're back into kind of neutral levels, but high end of neutral levels. So, you know, and again, like I said, very high bandwidth. You expect to start to neutralize a little bit. And so what we decided to do on that was to do an iron condor spread. If you take a look at the iron condor spread here, let's go to market outlook. We sold the, we'll come here to the trade tab, sold the 212.5, 210, sold the 230, 232 and a half. We position size fully because of the earnings announcement. We don't have to worry about that. So we got the, if you go out to or April expiration, excuse me, this is where we're at, right smack dab in that range. So as long as we stay in this area, and you can see we got a little bit of risk on the downside, a little bit of risk to the upside, but that's okay because I got an old high point up there. I've got these, you know, this volume support down there. So we can stay easily kind of in between there, centered around that point of control, and we would be just fine. That's how we make money on this trade. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Also, remember you can subscribe to our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next time.